Well, Kelly, Bloomberg has reported that the White House is looking at raising the top rate on high-income earners to 39.6%. They would then tax capital gains as ordinary income at that higher rate for wealthy households. Bloomberg is also reporting that the administration would keep in place the net investment income tax, which is a 3.8% surcharge on investment income.
Come on. I mean, I
All right. Today is Thursday, April 22nd, and this is a recap for the stock market activities today. Folks, remember this? The wall of worry and how the market continues to ignore all of these factors by channeling its inner Taylor Swift. Higher inflation, shake it off. Tightening monetary policy, shake it off. COVID-19, shake it off. Tensions with China, shake it off. Higher taxes, shake it off until today. Because President Joe Biden announced his plan of almost doubling the capital gains taxes for the rich, specifically for gains over $1 million. And right away, the market that has been shaking off the no-brainer worry of higher taxes, we all knew that the moment the Biden administration took office. Yet as these threats start to materialize, the market all of a sudden have no choice but to face the music. And in this case, we now have specifics regarding the higher taxes regime from the Biden administration. Higher taxes, whether it is capital gains or corporate taxes, will shrink the multiples for companies' stocks. You can't say transitory on this one. Higher taxes, that's just transitory. Brush it off, shake it off, just like we have been shaking off higher inflation. Yes, inflation is here. We continue to see inflation rising every single day. But the market continues to shake it off so long as the quote-unquote transitory argument is still alive. But at some point, these worries of higher inflation will start to also materialize, and therefore the quote-unquote transitory argument will also go out of the window. But for now, the immediate source of worry is higher taxes because it was announced today. I have no doubt that the Wall Streeters and the likes who want you to stay in this market will say, well, it will never pass. It's a negotiation tactic. They're not going to double capital gains taxes. Perhaps they're just going to settle for a bump in capital gains taxes, but not doubling the rate, perhaps increasing it by 25%, 50%, but not doubling the capital gains taxes. Regardless, the damage is already done because this market has been riding high with insane levels of valuations. So if you are going to tell investors you've made a lot of money, you're sitting on millions and millions of dollars of gains. Oh, and by the way, we're going to raise the taxation rate for your capital gains. What will that do? It will incentivize them to book profits now to keep more of their gains rather than giving them away to the tax man. We will talk about this issue and a lot more in specific updates for the situation with Tesla. But for now, let's start the coverage by going over the market performance today. And here we go. The Dow Industrial Average closing in the red, down 321.41 points, or a decline of 0.94%. The Nasdaq down 131.81 points, or a decline of 0.94%. The S&P 500 also down in the red by 38.44 points, or a decline of 0.92%. And what about the sector's performance? Every single sector of the market closed in the red, and therefore we're not going to give any medals today. Leading the decliners, materials, energy, and technology. This is one of those panic days where you sell everything, the inflationary, the disinflationary, reopening, stay at home, doesn't matter. You sell everything. What about the advance to decline ratios? For the New York Stock Exchange, 35% advancing versus 63% declining, overwhelmingly to the downside, but doing a lot better from a couple of days ago. So perhaps either the market did not absorb the full shock of raising capital gains taxes, or the market is about to shake it off too, based on, oh, but it will never pass because of the votes, and it is just a negotiation tactic, etc., etc. We will know the answer for this question by tomorrow. If the market drops significantly, it means that the market thought it over during the night and decided that this is a legitimate worry that should cut multiples in the market. If we, however, see a green day tomorrow, then you'll know that the market processed the information and decided to shake it off because Joe Manchin is not going to pass the bill, or it will never get enough votes. Perhaps Nancy Pelosi, because she likes to gamble with stock options. When Nancy plays, she's playing big. She's a high roller in the options market, millions and millions of dollars. Perhaps Nancy will grab Biden's arm and say, hey, doubling the capital gains tax is a little too much here. Let's just do 25%. How about that? So we will know tomorrow what the market is thinking about this capital gains taxes issue. What about the NASDAQ advance to decline ratio? A little better than the NYSE. We have 48% advancing versus 49% declining. Once again, we have earnings. A lot of people want to book profits prior to earnings, but others see it as an opportunity to buy shares in these big cap technology names, meaning that earnings will surprise to the upside and the recent sell-off in technology in the NASDAQ is not justified. We will see. Moving on to futures. Crude oil muted for the day. The WTI and crude oil with very modest gains, less than half a percentage point apiece. What about softs? Lumber, no stop and sign here. More gains for lumber. And then we have OJ, and OJ is starting a rally to reverse the recent negative trend. Likewise, we saw gains for coffee futures. Meanwhile, sugar, coca, and cotton futures pretty much muted, flat for the day. What about metals? We are seeing a mini retreat for gold and silver. Matter of fact, across metals futures, including palladium, which reached all-time highs yesterday. We saw the US dollar rebounding slightly higher, and that is adding pressure on copper futures. Copper futures are more sensitive to the movement in the US dollar. Gold is more sensitive to the movement in the 10-year Treasury yield. What about meats? Losses across the board led by feed or cattle futures, lean hogs, then live cattle futures. Moving on to grains. Green across the board, massive gains all the way from oats to soybeans. Meanwhile, canola flat for the day. But these are massive gains, folks. Rough rice up over 4%, wheat over 5%, corn over 4%. These are massive gains. When you ask about inflation, here is inflation with no stop and sign. What are we going to print 3D corn? Or the demographics? But the demographics. The demographics are going to produce more corn magically. Moving on to the big casino, the options market. We have a slight uptick for options trading, at least in Apple and Tesla. Apple at number one with about 1.2 million contracts traded today. About 68% of those were calls. Tesla, number two, with about 700,000 contracts. About 56.5% of those were calls. And number three, NIO, with a little over 600,000 contracts. About 70% of those were calls. We saw an uptick in options volume for both AT&T and Nikola. AT&T rising higher on the heels of earnings. And we saw an uptick in call options buying. And then we have Nikola rising on fraud optimism. Somebody said something positive about a fraud company, all of a sudden exciting a gamma squeeze in the options market. What about the unusual activities that took place in the options market today? Starting with the triple Qs, the NASDAQ. This time around, we have a bullish call, a bullish bet, which is quite peculiar because all of what we've been seeing the last few days is massive put options buying for the Qs and other indices. But here we have a bullish one. They are buying the 364 calls, expiration date June 18th, with expectations that the Qs would rally over 9% by then. They were willing to pay $1.55 a piece to enter this trade, all in all bringing the total to about $2 million. What about the trade for the ticker MU, Micron? Here is a value name that should be appreciating under the current conditions dictating the market. You see names like IBM and Cisco, these quote-unquote value names within the technology sector rallying higher. So why doesn't Micron also rally higher? My guess is that Micron is lumped in semiconductor ETFs, and they get bought and sold indiscriminately all together. If the ETFs get sold, the Micron gets sold with them. But here we have somebody betting for a breakage in this trend by making a bullish bet on Micron, buying the 96 calls expiration date May 21st, with expectations that Micron will rise over 13.5% by then. They paid about 60 cents a piece to enter this trade, bringing the total to about $700,000. And what about the trade for the ticker KWEB? And pay attention here, because this is a complicated one, a very sophisticated trade, at least according to my interpretation. You want to learn how the pros do it? Here it is. This is, by the way, the Chinese Web Services ETF. In essence, this is a high conviction bearish trade against the KWEB, because they're opening a credit spread, a call credit spread, and they're using the proceeds to buy a put. And the point from this strategy is you have a high conviction that the name will drop, and therefore you are willing to expose yourself to the upside risk because you think that's not going to happen, allowing you to minimize the entry cost for the trade, and therefore making the possibility of this trade to become extremely profitable if it goes your way highly likely. So here it is, and they are eyeing the June 18th expiration. They bought the 85 calls and they paid about 90 cents a piece to open this one, and then they sold the 80 calls and they collected $2 a piece from opening this one, this leg. All in all, so far they spent 90 cents and they received $2. So now they have about $110 in extra credit. They are using that credit to buy the puts, in this case the 68 puts, which cost them 115 cents a piece, meaning they used the $1.10 they received from opening the call leg, and they added about 5 cents a piece to enter this trade. All in all, the total entry cost for this trade is about $50,000 because the entry cost is about 5 cents a piece. Now, the KWEB is trading at around $76 per share. Let's say that the KWEB drops all the way to 65 by the expiration date of June 18th. Now this trader will end up gaining $3 a piece for this trade. Remember, the entry cost was 5 cents a piece. Meanwhile, the gains, if the KWEB closes at 65 by June 18th, will be $3 a piece. This is a profit margin of 60 times the original cost of entry, meaning scoring about 6,000% gains. Brilliant, worth taking the risk. And I did follow this one. What about the trade for the ticker DNMR? This is for Dannemar. They're buying the 25 calls expiration date May 21st, with expectations that the name will rise 7% by then. They paid about $1.70 a piece to enter this trade. All in all, bringing the total to about $1.2 million. Lastly, what about the trade at the bottom of the table for the ticker AMD? For, you guessed it, AMD. They're making a bearish bet here by buying the 72 puts expiration date May 21st, with expectations that the name will drop over 9% by then. They paid about $1.30 a piece to enter this trade, all in all bringing the total to about $700,000. Moving on to the headlines that shape the day, starting with macro news. Remember, good news for the economy is bad news for the market. Meanwhile, bad news for the economy is good news for the market. Why is that? Because the market is a cocaine addict. What is the cocaine? Fiscal and monetary liquidity, but specifically monetary liquidity. Now, if the economy is recovering fast, creating jobs, opening businesses, wages rising rising higher, then the Federal Reserve will have to taper the cocaine operation, and therefore the market suffers a withdrawal, even though the economy is heating up and doing excellent. So keep that in mind, because here it is. In the morning, we received the weekly jobless claims. First-time claims for unemployment insurance totaled 547,000 last week, below the 603,000 estimated by the Dow. Now, is this good news or bad news? This is good news for the economy, meaning bad news for the stock market. The dip in jobless claims looks good in isolation, but what really matters is that it confirms that last week's unexpected plunge was no fluke. Some smarty pants said, "We expect further declines over the next few months as the reopening continues, while payroll growth will accelerate markedly." Still, about 8 million fewer Americans are at work than before COVID. I think they meant out of work. You know, these geniuses they hire over at CNBC. Anyways, how do we read this, by the way? We have job openings all over the place, but we still have a lot of people unemployed, yet they're not looking for a job. And therefore, employers will have to offer more candy to incentivize workers to apply, therefore adding wage inflation. But hey, let's shake it off. So long as Papa Jerome says it's transitory, and if it's not transitory, he got the tools. It's like the doctor saying, "Hey, you got cancer, but don't worry, because the cancer is transitory. It's just gonna stay in your body for a little while. Just say hello and then leave. And if it doesn't leave, if it is not transitory, I'm just gonna have to kill you." Some 17.4 million Americans are still receiving benefits under various programs. Ta-da! Why do I need to find a job when I am getting a UBI in my digital wallet? Sharp increases in those applying for benefits through pandemic-related programs boosted the total recipients by nearly 500,000. Continuing claims, which run a week behind the headlines data, also fell, dropping 34,000 to 3.67 million, a fresh pandemic low, another indication that conditions are thawing. Once again, good news for the economy, bad news for the market. And here is the question: after the quote-unquote the greatest experiment in financial history, the mad scientists who ushered the tsunami of liquidity up to 12.3 trillion in stimulus has effectively killed off US default cycle. The more pertinent question for the markets perhaps isn't whether we are in a bubble, but rather what the consequences are of an era of free-flowing credit. Let's translate this into normal human beings' language for those of us who did not go to Harvard. Lisa's asking, after the tsunami of liquidity, trillions and trillions and trillions of dollars, we have pretty much killed bankruptcies and defaults, because companies, if they screw up, they are never going to go bankrupt, because so long as they have assets, tangible or intangible, they can secure loans, raise credit, raise cash by using collateral. So the question is, not whether this is a bubble or not, we all know this is a bubble, but what are the consequences of having a financial system with no consequences? Get it? You play with the money, you pay bonuses for executives, share buybacks, and then you screw up, your stock crashes, you're not going to go bankrupt because cash is easy. What are the consequences for this system? Perhaps inflation, out of control inflation, and more risk-taking, just like we saw with Archegos Capital, leading to more unknown disasters. And when we talk about inflation, here it is, food prices rising to the highest levels since 2014. And this is, by the way, just one index. There are other indices showing the highest price increase in food prices in more than a decade. Here is another example of inflation. Used car prices to the moon, bro. The Mannheim's pricing gauge jumped to a record high in April. Prices boosted by short supply and improving economic outlook, meaning that we have shortages in the supplies needed to produce new cars, and therefore buyers are resorting to used cars. But nobody wants to sell their cars right now, and therefore there is a shortage of used cars, and that is pushing the prices higher and higher and higher. Once again, this is a seller's market, not a buyer's market. If you have to buy a car, then good luck. But if you have a used car, maintain the car, change the oil, make sure it runs okay, because you could be sitting in a gold mine here. As prices surge higher and higher and higher, perhaps you can sell your car, book that profit, and wait till the bubble busts if you don't need the car. And we are talking about used car prices here, specifically for the most reliable and most demanded brands, Toyota and Honda. The highest price increase was for the Toyota 4Runner. This thing, even if you got one from the 90s, it still costs an arm and a leg. So if you got the 4Runner or even the RAV4, perhaps you want to think about selling those because the prices are climbing higher and higher by the day. And here is the story of the day, the capital gains increase proposal. Biden to propose capital gains tax of 39.6% to fund education, childcare, climate change, billboards, save the zebras. It doesn't matter. There are so many spending programs your head could spin. Biden will seek to raise taxes on millionaire investors to fund education and other spending priorities. As part of an effort to overhaul the U.S. economy, Biden will seek an increase in the tax on capital gains to 39.6% for those Americans earning more than $1 million. And when they say $1 million, it goes down to $500,000. All of a sudden they're going to start taxing, the day traders, small-time investors. We're taking a lot of risk here to make the money. So we deserve to be taxed less than regular income because there is a risk element involved. But even if they don't increase capital gains for small-time investors, what they're going to do is adding more taxes for each trade to target the frequency of trading to quote-unquote eliminate the gambling element of the market. And all of what that's going to do is making trading and investing in the stock market less accessible and more difficult. Remember, you want to talk about equality and specifically racial inequality. The Federal Reserve says we want to continue the easy policy of flooding the system with more printed cash because our new employment target is not just an overall number, but it has to be specific to disadvantaged groups. For example, women and Black Americans. Now, the majority of wealth creation is happening in the stock market and real estate values, but specifically in the stock market. The majority of owners in the stock market, the people who hold the majority of shares in the stock market, happen to be in the 1% and also happen to be white. So if the Federal Reserve wants to reduce income inequality and wealth inequality, racial inequality, they have to incentivize people to participate in the stock market, not push them away. And I know we're not there yet, but this is the trajectory. First, let's raise the taxes, the capital gains taxes for millionaires. Okay, got it, understandable. They had it good for a long time. It is about time for the rich to pay their tab. But will the Biden administration differentiate between the retail investor and trader and the Wall Street and Silicon Valley millionaires? That is the question, and this is the concern for now, at least from our side, the retail traders and investors side. Once again, we're taking a lot of risk here to make an income. In theory, we deserve lower capital gains taxes, not higher. Moving on to market sentiment news. I'm building on the conversation of increasing capital gains taxes. Here is the headline from Bloomberg. Fat valuations. What's with the fat shaming? You want to get canceled, Bloomberg? You want to talk about demographics? The fastest growing demographic in America is of fat people. Watch it, Bloomberg. Watch it with the fat shaming. But fat valuations and tech stocks seen at risk in Biden tax plan. Listen to this. Capital gains tax hike could cut the S&P 500 valuation by 7%, UBS says. We talked about pricing in stuff in the stock market. When stocks are trading at all-time highs, they're not pricing in the bad news. This is part of the bad news. So UBS is saying the market should go down 7% in order to price in this bad news. I say how about 10 to 15% down? That would be adequate to price it in. This is only for capital gains taxes, by the way. If we get corporate taxes, perhaps that's another 10 to 15% down. And indeed, valuations are fat and they need Oprah Winfrey's help. For example, here is Apple, the PE ratio, the price to book ratio, and the enterprise value by EBITDA. The valuations for Apple, the biggest stock in the market, are highly stretched from a historical perspective. We're talking about the biggest stock in the world, diverging from its historic valuation metrics, not for one metric, but for three, all elevated from historical levels. Now, did anything change for Apple to bump all of that premium into the valuation all of a sudden? What changed in Apple? Are they building spaceships? Did they discover another planet? Or did they just added new colors to their products? But hey, purple optimism, that's worth what, 1 trillion? That color purple, oh, oof, so beautiful, so dazzling. It's worth 1 trillion. And by the way, speaking of market sentiment, we have seen implosions of these fat valuations all over the market. We're seeing the bubble popping all over the market. Are you paying attention or not? For example, we have the Archegos mania in Viacom, Discovery, and other Chinese names. That blew up, that bubble busted, and we have Credit Suisse, one of the largest banks in the world, as a massive victim here of the implosion of Archegos Capital. By the way, this is one of the largest banks in the world, and it is giving money away like it is giving candy. No checks, even though they know that Bill Wong is a degenerate gambler and a criminal, a convicted criminal. But they extended lines of credits worth billions and billions of dollars to this man regardless. And now Credit Suisse saying that they have $20 billion. Once again, $20 billion in exposure to Archegos investments. What happens when a massive bank like this explodes? What happens to the unknown factor? Do we even know what is the next quote-unquote family office that's about to explode and take down other financial institutions down with it? We have no clue because family offices are not required to file with the SEC. We have no clue. We got our blindfolds on and we are crossing our fingers that nothing bad will happen, even though we are running toward the cliff. Another bubble that busted already, the SPAC mania. Check out the capital raised by SPACs, peaking earlier in the year during the first quarter, and now it's pretty much gone, disappearing, not even there. The SPAC mania, the SPAC bubble, already busted, already popped. Look at all of these SPACs, all of these mania names, mania ETFs, the retail crowd favorite names. You know, these geniuses who get their investment advice from TikTok and Zip Trader. Well, here it is. All of these hot names from last year down big so far. Double digits. What about the ARK mania? That's another bubble that already popped and it will continue to pop even more as we go. All of these ARK ETFs, innovation, revolution, throwing all of these buzz names. Cathie Wood knows how to sell dog shit to people. You thought sell me this pen is ridiculous. Cathie Wood is selling this dog shit and people are buying. Matter of fact, here is one of those headlines that you want to keep for your grandkids. One day when they have their own bubble, they ask you, Grandpa, Grandma, how did you handle the 2020 bubble? What happened there? You're going to remind them of this person called Cathie Wood, aka the Tom Brady of investing, at least according to this moron. And what happened to the Tom Brady of investing, by the way? Oh yeah, ARK Invest blew up, investors lost millions and billions of dollars, the stock market crashed, but Cathie Wood got to keep some of her millions. Oh, what a beautiful bedtime story, Grandpa. Here's another one, a poster for the bubble. Time magazine says why you should be worried of claims that the stock market is in a bubble. Don't worry about the market being in a bubble. Be worried about claims that the market is in a bubble. And here we are, the year is 2025. Remember the 2020 COVID bubble and the market didn't recover yet? And back then, the sentiment was insane. Here's an example from Time magazine. What else? Is there another bubble that has already popped or about to be popped? How about the housing bubble? People are searching more about the housing bubble on YouTube and Google. They want to know when the housing bubble will pop. And the reason is they have cash, they're waiting and waiting and waiting for better prices. And every day, prices continue to go higher and higher and higher. So they're asking, when will the bubble pop and we get to buy houses for cheap? I got bad news for you. The housing bubble is not going to pop anytime soon. Matter of fact, it's going to get hotter and hotter and hotter because all of these people Googling when will the bubble bust in the housing market will realize that the supply is is not here, and every house they've been looking at is being sold. They're going to start to panic, and they will buy houses anyways, perhaps above the asking price, pushing the bubble to become bigger and bigger and bigger. Of course, there is the eventual implosion of the bubble. That's going to happen 1,000,000%. And when it happens, the bigger the bubble, the harsher the crash. Here is another bubble that is perhaps already popping as we speak, the Dogecoin mania. Dogecoin Army's campaign to drive crypto to $1 was a bust. So why are the bulls feeling vindicated? Because they're a bunch of zombies high on meth looking for the next score. There is no intelligence here. First of all, this cult mentality of calling yourself an army is moronic. It is quite laughable because there is no army here. This is a tulip mania and there will be lots of backstabbing. All of those early entrants to the trade in Dogecoin, the ones who've been pumping it in social media as the price continues to rise higher and higher and higher, and the morons join the trade, forming an army, the insiders who've been pumping push the sell button and they take a massive dump on the head of the quote-unquote army, backstabbing them just like that, and getting away with millions and perhaps billions and billions of dollars. And the army, they form an empathy group, social group, and they share their diamond hand stories. Speaking of the pumpers for the tulip mania of Bitcoin and other cryptos, let's talk about Elon Musk and Jack Dorsey. We know that Elon Musk is an egotistic asshole who doesn't care about anything but himself. But Jack Dorsey, on the other hand, pretends to be a friend to the environment, a woke person, the new Hare Krishna, but somehow he is also pumping Bitcoin, which is the worst thing going on for the environment right now. It is a dirty, dirty, nasty business for the environment. So Mr. Dorsey, you want to be woke and a friend to the environment, then stop pumping Bitcoin. Oh, but you know we are fair and square, fair and balanced in this channel. So we represent the bull arguments for the tulip mania, and here it is. I don't think this is a bubble at all in Bitcoin. This is the beginning of mainstreaming, or of the mainstreaming of it meaning Bitcoin, says Stock Market Pro Bill Miller. And his argument is the supply and the demand. There is a lot of supply, there is a lot of demand, but the supply is scarce. I mean, we have to pollute the environment even more to increase the supply of Bitcoin. So here it is. That's your bull argument, supply and demand. When the first tulip falls, they're gonna run to the exit door all together at the same time, crashing this thing down. So yes, the supply is not here, but the demand will also drop. And you guys know what's going on here. The viewers of this channel are smart enough to know that what's happening right now is tick-tock, tick-tock, tick-tock. The bubble is gonna blow up very, very soon in the stock market. And by the way, corporate insiders also know that the bomb is ticking and the party is about to be over. And therefore, they're dumping a massive amount of IPOs, taking any horse manure company into the public market to exploit this mania before it's over. Once again, the insiders dumping, meanwhile the zombies in the retail quote-unquote investors are buying. Here it is. Stock market sentiment shift after investor euphoria pushed U.S. equities to record highs. U.S. equities had their biggest outflow, paying attention or not, last week since mid-November, and the fifth largest since 2008. I repeat, the fifth largest since 2008, according to Bank of America Global Research Report on Tuesday. Investors sold a net $5.2 billion in U.S. equities, with retail clients being the only buyers last week as the S&P 500 rose to all-time highs. The retail crowd were a bunch of zombies, were a bunch of donkeys. You dangle the lottery ticket in front of us, we're gonna go Naruto style, stampeding heads first right over the cliff. Retail clients have been buyers for the 8th straight week, while hedge fund clients sold for the 3rd straight week. Bank of America equity and quantitative strategists said in their note on last week's U.S. equity flows. They said 4-week average flows had been quote-unquote trending lower recently and turned negative for the first time since mid-February in a pause to the quote-unquote increasingly euphoric sentiment. The record stock market is showing signs of cracking. The public buys the most at the top and the least at the bottom. Does the shoe fit or what? The market is showing some signs of exhaustion, and with good reason. Most major parts of the market have run up significantly in the past month. Remember the Tetris example? But there is a growing Cheerios warning that we are at a peak, or quote unquote peak everything. That is peak earnings growth, peak economic data, and peak reopening. Bingo. Despite the stretched valuations, retail investors are pouring money into the stock market. During the first 3 months of the year, they bought a record $300 billion of equity exchange traded funds, according to JP Morgan Markets strategy team led by Nicholas, whatever that is. Moving on to corporate specific news, starting with, you guessed it, Tesla, the souffle. You know, the souffle enthusiasts and culties are saying it is impossible for the crash that happened in Texas to be due to the FCD program, the autopilot program, full self-driving vehicles program from Tesla. And the driver was recklessly driving the vehicle, and once he crashed, he decided to go to the back seat to make Elon Musk, our beloved Lord and Savior, Reverend Elon Musk, look bad. The culties are absolutely insane. It's quite laughable. The excuses and the conspiracy theories they make to defend their Lord and Savior. But here we have Consumer Report showing us that it is so easy for the FCD program to take over the vehicle even though no one is sitting behind the driver wheel. Consumer Report engineers show a Tesla will drive with no one in the driver's seat. After a fatal crash in Texas was demonstrated how easy it is to defeat autopilot's driver monitoring. In our evaluation, the system not only failed to make sure the driver was paying attention, but it also couldn't tell the difference if there was a driver there at all. Tesla is falling behind other automakers like General Motors and Ford that models with advanced driver assist systems use technology to make sure the driver is looking at the road. So the systems in General Motors and Ford vehicles are superior to those in Tesla. But hey, the self-driving vehicle optimism, bro. Tesla's a monopoly. It's ahead of all of those dinosaurs. So the valuation should be $4 trillion, even though the company makes no profit. And here we have tough guy, Reverend Elon Musk, bowing down to the CCP, apologizing, please forgive me, and promising that the data it receives on Chinese drivers will be stored in China. But the CCP and the Chinese authorities are not impressed at all. Tesla apology lacks sincerity, and this is from the official Chinese news agency. And this is not the only bad news we got for you on the souffle. We got more. The souffle is losing talent. Tesla Vice President of Legal Al Prescott leaves to join Luminar, a LiDAR company. We know that Reverend Elon does not believe in LiDAR technology, but Luminar is one of the most promising companies out there. It's a no-brainer buy. The ticker is LAZR. However, I wouldn't buy it right now because the valuation is insane for a company that doesn't make profits or even revenue. But if there is an event of a market crash, then I am buying the stock. With my blindfolds on, Luminar stock could gain 40% as it racks up partnership for its autonomous vehicle LiDAR technology, Bank of America says. Now, if you got FOMO, you don't want to wait for a crash to buy the stock, you can participate to the upside if there is another leg in the mania by buying call options. Simple as that. But Tesla's a monopoly, bro. Tesla's the future, bro. You want to know the future? At least in China, it's actually NIO. NIO is kicking Tesla's ass in China, and NIO wants better US-China cooperation, meaning that NIO is saying we want to start selling cars in the United States. If that happens, by the way, forget about this whole Tesla's a monopoly bullshit argument to begin with. Chinese Tesla rival NIO targets Europe with its smart EVs as it takes a first step towards going global. And of course, the Chinese government will support NIO over Tesla. That is a no-brainer. Norway looks set to be the first market that NIO will explore outside mainland China. Norway is the biggest EV market in the world. The problem with NIO stock and Xpeng stock, by the way, is the valuation. The valuation is lousy. So yes, NIO someday, I do believe that, will be worth about $100 billion. but not right now. So unless you're planning on holding a bag for the next 5, 6, maybe 7 years, you shouldn't be buying NIO right now. It will crash, it will come down, but eventually it will climb higher and be worth what it is right now. The case for any good investment depends on the entry price. Those who bought NIO for $3 don't have anything to worry about. They just go to sleep and wake up 10 years later. But those who bought NIO at the top will have a lot of nightmares. Valuation, folks, they matter. Fears of rising competition might be one of the reasons Chinese EV stocks are struggling in 2021. NIO, XPeng, and Li are down about 21, 17, and 24% respectively. BYD, another large EV player, and Warren Buffett, Berkshire Hathaway, like the stock, is down about 12%. But here it is. Now you know why the Maverick of Wall Street has been touting Ford stock since the beginning of the year. Back in January, I've been saying buy Ford, buy Ford, buy Ford. And what do you know? Ford stock is up about 40% since then. And the reason is, it is also involved in the EV wars, but it is underappreciated. And here it is. Ford is coming for Tesla and NIO in China, right? NIO thought it was tough, beating Tesla in the ring, jabs, body slams, but here comes Ford into the ring with a steel chair. Moving on to the heat map analysis, and let's see what took place in the market today. Everything was hunky-dory in the market, at least in the morning. Yes, some stocks opened lower, but the buying started early in the morning, and stocks were trading in the green. But midday, Uncle Joe did us bears a favor and caused a mini crash in the market, so I guess we owe Uncle Joe a favor. Perhaps I'll consider voting for him next time if he is still alive. But you gotta do a little more, Uncle Joe. You gotta crash the market a little more than this. Don't get me wrong, this is a good start though. Anyhow, the advantage in the morning, at least from my observation, the Nasdaq and the mania names were taking the lead because treasury yields remain stable, actually trending to the downside. Therefore, the Nasdaq is leading, specifically the mania names. We saw some of the mania names actually managing to close in the green today. For example, Palantir closing in the green about 1%, NIO almost 2%. The solar names also closing in the green, along with certain names reacting to earnings. For example, AT&T closing massively in the green today, over 4%. We also saw DHR and the Blackstone Group also closing with gains over 3% today. Other than that, we saw a reversal in the market overall once the announcement that the Biden administration is proposing doubling the capital gains taxes hit the air. Everything started to reverse, and all in all, we got a red picture across the board. The question is, how will the market react tomorrow? Will we get a confirmation with another sell-off and the market finally not shaking off any of these concerns, in particular the taxation concerns? Or will the market also shake that one off due to negotiation optimism, or, oh, it's not going to pass? We will see. What about the themes, the different themes of the market, starting with the reopening names? Mixed picture across the board. And once again, certain names, the likes of the travel names, I do believe that these will get hit hard when earnings are released. And the reason is they've been riding high, exceeding the pre-pandemic highs. So for a lot of these names, the good news is already priced in. For other names that are still down, haven't recovered the pre-pandemic highs, for example, AT&T, you saw the reaction for earnings today. And here we have other names, the likes of Coty, Diageo, Cheesecake Factory. These could run a little hotter, but I am bearish on the names that already ran hot. For example, MGM Grand, Hilton, Marriott, Disney, even American Express, which is reporting tomorrow, by the way. What about the inflationary trade? Negative picture overall, losses across the board. We're seeing also profit taking from these high inflation names. And the reversal was very clear the moment Joe Biden announced his proposal of doubling capital gains taxes. Think about it. If you made millions of dollars trading these stocks or even technology stocks, why would you wait for capital gains taxes to increase to double when you can cash in now, book the lower rate? You are also vindicated and have a source of comfort with your decision to hit the sell button, cash in your profits right now is the quote-unquote fat valuations. The risk versus reward is not worth it right now. If you made millions and millions of dollars of gains, you book them now before any negative surprise to the downside due to earnings and before taxes go higher. It's a no-brainer. What about the disinflationary trade? Mixed picture, but mostly in the green, not by much though. We need to see the reaction of the market tomorrow. For that, let's move on to the technical analysis, starting with the SPY 30 minutes chart. We talked about the cup and handle formation, and that was playing to the upside, until Uncle Joe decided to crash the party. Uncle Joe does not believe in coffee or cups. He doesn't like them. He only uses cups when he wants to read his fortune. And therefore, crashing the party, and now we have a bear flag formation. But we are at a very strong support. Take a look at the chart. We bounced from these levels of about 412, 410. We bounced from this level. Not once, not twice, but 3 times. And therefore, yes, we have a bear flag formation, but we also have a strong, sticky support for now. It will be tough. It will be a battle. And therefore, the decision tomorrow is extremely important. If the market is going to continue in this bearish trend, not shaking off the risk of higher capital gains, breaking the support zone of 410, then the destination and the next support, the center of gravity, will be 406, and that will be the first batch of declines. Perhaps we can bounce from there and take it one day at a time. What about the broader picture from the SPY futures? I'm not liking this. We are trading at all-time highs, but once again, the RSI is curling downward. The MACD indicator is making a crossing imminent, a negative crossing, which will show up in red impressions on the histogram. The volume is also accelerating, so you have 3 indicators here supporting a reversal from this level in the SPY futures, and therefore we're giving the thumbs down on this one. Where is the support? How far can we go if we indeed continue to reverse? We do have a gap to fill. You see the yellow circle between the 2 bull flags, that we have 3,960. That's a strong level of support. If that doesn't work, we have the yellow trend line, the ascending yellow trend line, along with the level of 3,862. But the first one to look forward to is closing the gap and see how the chart will react from there. Of course, this is under the assumption that the market will not shake it off. But you have to remember, the technicals are strongly suggesting a reversal. Moving on, the Qs, 30 minutes chart. We saw the cup and handle formation, head and shoulder, reverse head and shoulder, whatever you want to call it. It doesn't matter. It was a bullish formation, at least from a 30 minutes perspective. And it did indeed play out to the upside. However, once again, Uncle Joe crashing the party, and now we have a bear flag formation. If the market decides to go down, the Qs are expected to go back all the way 330.5. That is the first level of support, but the center of gravity remains 323. Moving on to the daily chart of the Qs futures. We are struggling at the level of 13,900 as expected. This is a sacred level and it should be treated as such. The chart should not just blast higher without spending a lot of time going back and forth, gathering the energy needed to break above it. And if there is no energy available to break above 13,900, then you have to go down to a former level of support to gather that energy. If the energy is not available at that level of support, then you have to go further down. So the first level of support is 13,599. If that doesn't work, we have 13,300. We also have the purple trend line. But remember, we have a negative divergence in the RSI. We have a negative crossing imminent in the MACD indicator. So once again, if you want to bet here from a technical perspective, the warning signals are there. It is worth a shot to buy some calls, at least for me, on the SQQs. And I indeed did that today. Moving on to the IWM 30 minutes chart, small caps. What's going on here? We blasted higher. We identified 223 as the next resistance. The Russell 2000 witnessed an increase in volume, a small one but noticeable. That was enough to blast above 223. But yet again, Uncle Joe crashing the party, the IWM cracked below the support level of 223. It tried to climb it back and it got rejected. This is a bearish signal, meaning if this indeed plays out, we will go down all the way back to 218. That will be the first level of support. What about the big picture? The daily chart of the RUT, the Russell 2000. The level to watch is 2,264. We have yet another rejection and the chart is struggling to break above that level. We have 1 day left in the week, tomorrow. You gotta close above that level from a weekly perspective to keep any hope alive that we have another leg higher in the IWM. Absent of that, the ultimate destination will be a correction in the IWM of over 10%, and then perhaps the dip will be bought. Therefore, the level of 2,264 is very important. And for now, the bears have the advantage. The negative divergence on the RSI persists. We don't have a conclusive crossing in the MACD indicator, but that will come imminently. Moving on, the dollar index. What's going on here? Bottoming, gathering some support at the level of 91, but the bullish trend has been broken. So even if the US dollar rallies all the way to 92, and by the way, if there is a sell-off in the market due to the capital gains taxation, the proposal, then the dollar should climb higher, all the way to 92. That will be the next resistance. And if it reversed from there, once again, then we will have a confirmation of breaking the bullish trend because we have a lower low, but we don't have a lower high yet. Keyword yet. If that happens, by the way, it will also be a head and shoulder formation. What about gold? Retreating just slightly today. We have a resistance, a soft level of resistance at 1800, but the stronger resistance level is 1825. For now, gold can go back and forth, but if the dollar doesn't go impulsively higher, and yields continue to stabilize or even trend lower, then gold could go all the way to 1,825 before stopping. What about Bitcoin? We talked about Bitcoin last night, and it's looking very bad, boys and girls. Cryptomaniacs, we are trading further away from the trend line. We're not climbing back the trend line. We're moving away from it to the southern destination. And the center of gravity now is 42,000. We have significant weakness in the RSI. The negative divergence is playing out, and we have a decisive crossing to the negative side in the MACD indicator, meaning that the momentum in the sell-off is accelerating. And what about yields? We talked about the bear flag in yields playing to the downside overnight but reversing during the trading session. However, Uncle Joe, once he announced his proposal, yields reversed lower. For now, we have to watch what yields wants to do, because the reason why yields reversed higher after the bear flag played out overnight is the double bottom formation. So yields should have had enough support to climb all the way to the level of 1.6, but due to the announcement of the capital gains increases, yields also reversed. So we have confusing messages here. Yields reversing lower along with the Nasdaq. One of these two is lying. Moving on to the TLT bond prices. We talked about the bull flag formation in the TLT, and that is indeed playing out. The first destination is 141. Closing above that level from a weekly perspective will open the door to the next destination, 143. So we are watching the weekly closing in the TLT. Very important. Closing above 141 means that yields will decline furthermore. Closing the week below 141, specifically if we see a reversal tomorrow, will indicate that yields are about to rally once again in the next coming weeks. Moving on to the VIX, what's going on here? A reversal of the reversal of the reversal. The market's confusing, isn't it? Not really if you have a longer term perspective and you are following the technicals. Because we had a crossing in the MACD indicator signaling a reignition of the momentum higher. So even if you see down days in the VIX, the momentum is to the upside, at least for now. And we reached all the way to the first level of resistance at around 20 and pulled back. And the VIX is reloading the gun, caulking the gun to shoot up higher, breaking the resistance of 20 once and for all. If the market, however, decided to shake it off regarding the taxation concerns, we could see a down day for the VIX. But for now, gathering all the information, technical and otherwise, the bears have the advantage, meaning the VIX bulls have the advantage for now. What about Apple? We talked about the bear flag formation. Apple trading a little higher today, but here comes Uncle Joe and the bear flag plays out. The center of gravity remains 131. Now, a lot of Apple holders don't want to liquidate their positions before earnings. They are optimistic that all of the stimmies we've been handing out will be beneficial to Apple's earnings. The counter argument is the name rallied significantly higher in the last couple of weeks impulsively, so perhaps it is already pricing in the good news, and the risk for disappointment is a lot higher. Moving on to Tesla, what's going on here? The souffle looking a little weaker today, but it did not break the support of 720, closing slightly below it, but not decisively. And therefore, the weekly closing will be extremely important. You want to see a decisive closing one way or the other, up or down from 720. Closing below 720 will accelerate the negative momentum. It is just starting to build up, by the way. The RSI, we have a negative divergence. It is very small, very short, not significant yet, but noticeable. Likewise, the MACD indicator is starting to curl downward. Not a major curling, but noticeable. So the weekly closing is very important. Closing below 720 decisively, say closing at 700, 690, 680 will confirm that the bounce in Tesla from the February correction is over, and perhaps we have another leg to the downside. What do we have on the earnings calendar tomorrow? We have American Express and Honeywell. Both of these names have been rallying impulsively since the Biden election of last year, so a lot of the good news already priced in. These results better be fantastic for these stocks to rally, specifically American Express. Last quarter's results were abysmal. Meanwhile, the stock already reclaimed the pre-pandemic highs. So the risk for a negative disappointment here is highly likely for American Express, absent of Amex showing a significant increase and a reversal in using the credit card to book upcoming trips, cruises, airlines, hotels, etc. But the results from American Express is highly important, not just for the company itself, but from the macroeconomic impact. It is a leading indicator. If we see booking for activities in travel, then that will add more to the outlook, the very positive outlook for the economy during the summer. And this very positive economy during the summer, the good news for the economy is bad news for the stock market, because it will confirm that inflation will continue to heat up more and more and more, perhaps surpassing the tolerance level that the Federal Reserve is eyeballing for now. Anyhow, critical earnings on the dock tomorrow. That's all I got for you tonight, and I will talk to you again tomorrow.
buy a shotgun. Buy a shotgun.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.